Yes, again, the risk with these companies, like with DV's last quarter, was whether this is peak earnings. And today, of course, pharma is not in focus. So after opening higher, Lotus is seeing a bit of a decline. So that's something we'll keep an eye on as well. Manishi Raychaudhuri is joining us, Asian Equity Strategist, Equity Cash Asia Pacific at BNP Paribas. Manishi, hi, good morning. Thanks a lot for joining us. Manishi, first up, what did you make of the market's reaction to Fed yesterday? The market latching onto the fact, one part of the statement where it says that, perhaps going forward, the rate hikes may come down. But they're still there. But the market just had a outside reaction, especially on NASDAQ. Your thoughts?
I think the Fed chair's statement yesterday was comforting to the markets on two counts. Number one, the possibility of the pace and the quantum of rate hikes being tempered going forward. There was, sort of a clear indication provided to that effect. And secondly, this use of the word soft landing. I think Chair Powell clearly indicated that there's no intention on the part of the Fed to engineer a recession or as a very sharp slowdown. I think, these are the two things that both the equity and the bond markets took some degree of comfort from. That said, we must also not forget that the process is not yet complete and the process would remain data dependent as we go along. We're also in the midst of a quantitative tightening, which the quantum of which is being increased as we speak. So it'll possibly reach a monthly peak in September. So yes, this is a relief rally, and that's good. That's clearly a positive for much of the risk appetite to come back eventually. But for most of the risk asset investors, our recommendation would be to still, watch very carefully as far as the monetary policy action globally is concerned.
Manishi, hi, morning. How are earnings here in India, which you track, under your coverage universe, looking like? Is that giving you cause for cheer, some upgrades in earnings overall, or not really?
Well, I don't think, in the early stages over the past couple of weeks or so, we have seen much to cheer about or much to be very cautious about. So we haven't seen too many upgrades or very significant downgrades. If I were to take away some of the key messages that have come through, let's say from the IT companies or from the auto companies, number one, the IT majors have talked about revenue remaining intact. Some of them have cut guidance slightly, some of them have raised guidance, and that's encouraging. But uniformly, they have talked about margins suffering as a consequence of outsourcing. So they're facing a manpower crunch, which is sort of established anecdotally, as we know that the compensation levels for IT and other service employees have gone through the roof over the past year or so. On the other hand, if I look at the auto manufacturers, I think the most encouraging part of their discussions is the gradual resolution, if you will, of the chip shortage situation, and consequently, they're going back into a much higher degree of capacity utilization, much higher degree of production mode, filling in the channel inventories, which both the two-wheelers and passenger car manufacturers have talked about. So it's kind of a mixed message at this point of time. But on the whole, given the situation that we're in right now with concerns about a recession, particularly in the Western Hemisphere, it's not a bad outcome, I would say.
Since you spoke about auto companies, I wanted your thoughts on what's happening with some of these large players, right? Say Tata Motors, for example. It's reported a huge loss of 5,000 crores. And now if we are heading into an impending recession in, say, the US and Europe, which are huge markets for Tata Motors, do you think the earnings could be further at risk?
Yeah. Now, we, at this stage, as far as the auto universe is concerned, we would like to make a clear distinction between the domestic players and the global players, and particularly those global players who are to a significant degree dependent on the Western Hemisphere. So our preference lies for the former pack, or in other words, the ones which are domestically focused. Those are the ones that we have in our model portfolio. And to some extent, I would agree that if we are looking at a potential recession or a sharp slowdown in the Western Hemisphere, then the globally linked or the globally dependent companies could suffer. There are silver linings as well. Pretty much all companies have talked about the chip shortage situation easing, and therefore they being able to fulfill the large order books that they have. But if I were to look at beyond the next 1 or 2 quarters and over the longer term, I think the domestically focused auto companies do appear better positioned.
Okay. Manishi, the big debate in India has been about the IT stocks. Now we've seen earnings from most of the large caps. Overnight, we saw numbers from Cognizant as well. What stands out is that there's an issue with the margin. While
Right.
top line is still okay. How are you approaching
Right.
the space now after the correction?
Now, IT is, very delicately positioned at this point because, on one hand, they are getting large orders from their customers who are all in the Western Hemisphere, and business spending or business spending intentions, rather, that do not seem to have suffered at this point of time. Um, and that is reflected in the kind of revenue guidances. We have seen some of the top rung companies even increasing their revenue guidance, which was, a kind of a surprise. Um, Margin pressure is obvious in a situation where the main raw material, which is manpower, has become costly, and the bench size of these companies have shrunk. They have reduced over the past 1 year, and therefore they're forced to outsource a large part of their work. So it's a kind of a tug of war between two variables, and I think this situation might continue. Therefore, right now one should possibly focus on those companies which are more confident about their revenue and top line growth going forward. The companies which are winning large orders and augmenting their order backlogs, which would give a visibility about the revenue over the next 1 or 2 years, which essentially are, the top 4 or 5 companies, really.
So in that sense, I mean, generally speaking, IT and digital adoption, and that seems to be I mean, that's a sector which can follow non-linear growth, right? Exponential growth, because of the demand for those services, and the growth in revenues not necessarily being linked to manpower increase, employee increase, although that's been a problem for IT services companies in the past.
Yep.
Would that remain the number one area, despite, I mean, all these near-term concerns in that sense, Manishi, for you?
Oh, clearly. In fact, you kind of hit the nail on the head. It's the companies who can reinvent themselves, who can offer value-added products and services to their customers, and therefore take advantage of that, the phrase that you rightly used, the non-linear growth. Those are the ones that investors should focus on. I won't name names here, obviously, but it is clear that it's really the very large cap, the top 2 or 3 companies possibly, who have historically been able to do that, who have the necessary management bandwidth to pull it off.
Any thoughts on NBFCs? The big move really is coming into names like Bajaj Finance right now. And across the board, the metrics have improved. There is all key metrics actually. Core AUM growth was 31% year on year. NIMs have improved further. Credit costs have come down to normalized levels for Bajaj Finance particularly. But overall, how are you positioned in this space?
The NBFCs, both in consumer finance and mortgages, they're essentially positioned on a domestic recovery. And the story in India is just that. The domestic economy is doing better than the external economy. The external economy still seems to be at risk as a consequence of fuel prices rising, the current account deficit and the trade deficit expanding, and the consequent impact on the currency. So the expansion in the domestic economy is visible in quite a few, quite a few indicators. If you look at bank loan growth, that's about 13 to 14% now. Traffic, both the passenger and goods traffic through road and rail have increased quite a bit. So, I think it is quite obvious that the NBFCs would do well going forward. That said, and this is one important theme that we're playing in India, it's called the so-called affluent consumption theme. The top 2 or 3 income segments in India are consuming a lot more, and they're likely to consume a lot more. Employment is being created among the skilled professionals, and the kind of NBFCs that cater to that segment of the population would possibly be better placed.
Okay, that's on the NBFC space, right? I just wanted your thoughts on metals because, Tata Steel has been in the news ever since it reported a very good set of numbers for its European business. The EBITDA per ton rose substantially, but the stock has still been a huge underperformer. Do you think fortunes could change, and how are you positioned?
One of the reasons for underperformance of the metals pack is the decline in industrial metals. The best example possibly is copper. If we're really scared about a recession in the Western Hemisphere, and in conjunction with that, the Chinese economy continues to drift along at a low level of growth, which we are seeing right now, then I think the metal companies would remain under pressure for now. And that's one of the reasons why we don't have any exposure to that space in our Asian model portfolio.
Manishi, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always.
Thanks again.